Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Mastering Income Statement Analysis, a guide for better financial insights. Understanding an income statement is key to grasping a company's financial health. It presents a snapshot of revenue, expenses, and profit over a specific period. With this insight, you can make informed decisions, whether you're an investor looking to buy shares or a business owner aiming to improve profitability. In this video, we'll break down the components of an income statement and show you how to analyze them effectively. We'll focus on identifying trends and spotting potential issues that could affect the bottom line. By the end of the article, you'll have practical tools to interpret income statements with confidence and clarity. Understanding the income statement. An income statement provides a clear picture of a company's financial performance. By breaking down the components, you can see how revenue flows in and how expenses affect profitability. Let's look closely at some key sections of the income statement. Revenue. Revenue, often called the top line, represents the money a company earns from its operations. There are different types of revenue. Sales revenue. This comes from selling goods or services. For retail businesses, this is the biggest piece of the pie. Service revenue. For companies that provide services, this is the income from delivered services, such as consulting or maintenance. Recurring revenue. This is the income that comes in regularly, think subscriptions or membership fees. Revenue recognition is important. Companies follow accounting standards to decide when to recognize revenue. For instance, some might count revenue when a sale is made, while others might recognize it when the service is completed. Understanding how a company recognizes revenue can reveal its financial strategy. Cost of goods sold, COGS. COGS represents the direct costs tied to producing goods sold by a company. This includes materials, costs of raw materials used in production. Labor, wages paid to workers directly involved in making the product. COGS is crucial because it impacts gross profit, which is calculated by subtracting COGS from revenue. A higher COGS means lower gross profit, affecting overall profitability. Keeping COGS in check can lead to better margins. Operating expenses. Operating expenses cover the costs of running a business that aren't directly tied to production. They can be classified into 2 main categories. Fixed expenses. These stay the same regardless of production levels, such as rent, salaries, and insurance. Even if sales drop, these costs remain. Variable expenses. These change based on production. Think of things like materials for products or hourly wages for staff. Higher production leads to higher variable costs. Understanding the difference helps in budgeting and controlling costs. Keeping a close eye on these expenses can boost profitability. Net income. Net income, often referred to as the bottom line, shows the actual profit after all expenses are deducted from total revenue. It's calculated like this: net income equals total revenue total expenses. This figure is crucial when evaluating a company's profitability. A consistent positive net income indicates a healthy business. Investors often look at net income to gauge past performance and predict future trends. Positive net income can also lead to reinvesting in the business or returning money to shareholders. Understanding these components of the income statement allows for a deeper analysis of a company's financial health. Each section tells its own story, and together they provide a complete picture. Types of income statements. When analyzing an income statement, it's important to recognize that not all statements are created equal. There are 2 primary formats: the single-step income statement and the multi-step income statement. Each has its own structure and serves different purposes. Let's break them down. Single-step income statement. A single-step income statement presents a straightforward approach to financial reporting. It summarizes all revenues and expenses in one step, making it easy to understand at a glance. The structure typically includes total revenues, all income generated from sales, interest, and other sources combined. Total expenses, all costs, including operating and non-operating expenses. The net income is simply calculated by subtracting total expenses from total revenues. Net income equals total revenues, total expenses. This format is often used by smaller businesses or those with simpler operations because it keeps things uncomplicated. It's a great choice when you want quick insights without diving into intricate details. However, it may not provide a complete picture of operational efficiency, which can be crucial for larger businesses or those seeking investments. Multi-step income statement. The multi-step income statement offers a more detailed view of financial performance. It separates operational revenues and expenses from non-operational items, allowing for better analysis. Key components include gross profit, calculated by subtracting the cost of goods sold, COGS, from total revenue. Gross profit equals total revenue COGS. Operating income. This reflects the company's profit from regular business operations. It's derived from gross profit minus operating expenses. Operating income equals gross profit operating expenses. Other income and expenses. This part includes non-operational items like interest income or expenses, taxes, and extraordinary gains or losses. Net income. The final figure summarizes the business's overall performance. Net income equals operating income plus other income, other expenses. The advantages of using a multi-step income statement are clear. It provides a more granular view of business performance, helping to identify how well the company is managing its core operations. This format also makes it easier to spot trends over time, as each line item can reveal insights about profitability and cost control. By understanding both types of income statements, you can better interpret financial data and make informed decisions. Whether you choose the simplicity of a single-step format or the comprehensive nature of a multi-step statement largely depends on your needs and the complexity of the business in question. Analyzing income statements. Analyzing income statements is crucial for evaluating a company's financial health. By examining the numbers, you can identify trends, compare performance to previous periods, and make informed decisions. Let's break down two important techniques for analysis: trend analysis and common size analysis. Trend analysis. Trend analysis helps you track financial performance over multiple periods. This technique allows you to identify patterns that might not be obvious in a single statement. By examining revenue and expenses over time, you can see whether a company is improving or declining. To perform trend analysis, follow these steps: collect data. Gather income statements for several periods, e.g., monthly, quarterly, or annually. Calculate percent change. For each line item, calculate the percent change from one period to the next. The formula is text percent change equals frac text current period text previous period text previous period times 100. Identify patterns. Look for consistent trends in revenue growth, expense increases, or margin changes. Contextual analysis. Understand external factors that could influence the trends, such as industry shifts or economic changes. Why is this important? Identifying trends allows you to anticipate future performance. For example, if revenues are consistently growing, it might signal a robust business model. Conversely, if expenses are rising faster than revenues, that could be a warning sign. Common size analysis. Common size analysis takes each line item on the income statement and expresses it as a percentage of total revenue. This makes it easy to compare performance across different periods or with other companies, regardless of size. Here's how to conduct common size analysis. Convert line items. Transform every line item into a percentage of total revenue. For instance, if total revenue is $100,000 and COGS is $40,000, COGS would be 40% of total revenue. Assess ratios. Analyze the common size percentages. This allows you to evaluate the cost structure and profitability at a glance. Benchmarking. Compare these ratios against industry averages or competitors. It helps you see how a company stacks up against its peers. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.